Tesla's main business is in trouble, right? And here's why.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk.
And we are back. Thank you for joining us for another edition of the Daily Dots. And I am not joined, as always, by the brain trust himself, Mr. Chase Taylor. It's his birthday today. So he's doing doing some family time and hanging out with the fam. So I told him I'd hold down the fort for us today. It's not new to me. Did this show for a lot longer by myself than I've done it with somebody else. So anyway, back to kind of old hat for me here. Anyway, interesting day. Well, not really. Just more, down day, up day. Let's see here, but let's get a rundown on the indexes. Everything was up big. S&P up right around 2, if not a little higher. Let's see here. Let's get to the rundown. Yeah, so S&P finished up 2.05. NASDAQ finished up 2.47. Small caps did pretty good too, 2.33. If you feel like you're having whiplash, you probably should. Just the news, I guess you'd say the news that came out today is Trump was backing away from some of the tariff talk on Europe and things like that. There's no question that had an impact. I think the biggest reason or the biggest driver of this rally today was rates. Let's see where we were on rates. The 10-year yield pulled down to 4. Let's see, where were we? 4.43. So you've backed off that 4.5 level, which does not surprise me. That gives you a bit of a reprieve. On the 30-year, you pulled back below 5%, so you're at 4.94. I'll be honest with you, the move on rates was a little bit surprising to me because, to me, very little of what was discussed today, meaning I don't see anything. Whether it's less tariffs, whether it's this, I mean, I don't think you're going to see anything that stops. Now, it's like I said, it's not going to just be a bath and everything American gets rinsed. But I don't think that, regardless of these trade outcomes, I don't think that you're going to watch, especially international money managers double down on the U.S. trade. I could be wrong, but I think that you're going to get a sell the rips type deal here. And that doesn't mean that doesn't mean the S&P can't continue to go up. We were at our investment meeting this morning, and look, this is all anecdotal, so take it with a grain of salt, as always. But it actually feels to me, when I'm looking at the price action, when I'm watching companies like CoreWeave up 17% on the day, I think that's what they're up on no news. Tesla ripping as news comes out that their business across Europe is down 50%, and BYD just cut prices by 30%. Like, BYD is trying to take Tesla apart, and watching Tesla rally in the face of this. Now, it's all based on the excitement for delivering full self-driving. But, this is nothing new on the Tesla side. That thing has never made sense on a price basis, and it certainly doesn't now. It's going to be really interesting to watch because, look, Musk is not a guy that I want to bet against for long periods of times. Now, we have had a really good run shorting his stock, shorting Tesla at various times over the last year. We've actually made money long it too. It's actually been shorting or going long Tesla has probably been one of our best trades over the last year and a half. But you're at this level here where the unknowns are so wide. when it comes to robo-taxis, due to the cost of Tesla cars, I don't think that they've got a big advantage. We know they don't have a big advantage on full self-driving because Waymo's way out ahead of them on that one. It's going to be interesting to see what Musk's next iteration is and the path forward for Tesla, because you got so much priced in, but the core business that's supposed to be driving the whole thing is getting obliterated, and it's in trouble. Tesla's main business is in trouble, right? And here's why. They didn't structure themselves to be a luxury car manufacturer. They structured themselves to be a mass market car manufacturer, right? That delivers cars at every price point. So think of the infrastructure spend and all that's gone into that, right? The capital investment that's gone into facilitating that. But when you see sales in Europe down 50%, and again, you read the thing, you read the articles about it, and they reference BYD and increased competition. But then it's the perception of Musk's political involvement. I think that had very little to do with it. And the reason I say that is you could see their sales were getting rocked before this. So, and it's just math. I mean, right? They had the nicest and the cheapest EV, that, highest quality. They right? The Model 3 was that deal. Okay, well, it's not anymore. You can get substantially cheaper from BYD with better interior, a classed up car. And that's going to be interesting watching, just because Tesla's up against it. And I think a lot of people are putting a lot of faith in their ability to dominate the full self-driving market and have the robo taxis not. And that's a lot of faith, because that's just not where they're at right now. So that's going to be an interesting one to continue to watch. Now, of course, another one that we're going to keep an eye on is NVIDIA. You've got their announcements coming out. Earnings are announced tomorrow. We're expecting to see some kind of groundbreaking stuff. We'd expect to see Chinese revenue eclipse the $6 billion mark. I really don't think you're going to see much of it. I would be really surprised to see any serious surprises out of NVIDIA's quarter. From everything that we can look at, demand is still there. It's really interesting. It's going to be really interesting to watch the NVIDIA saga unfold. I'm also very interested in listening to his conference call, because look, there's still tremendous demand out there for NVIDIA chips. And as long as that demand stays anywhere close to where it is right now, I actually don't think NVIDIA is that crazy expensive, assuming demand stays there. Now, the problem I've got with this is everybody I talk to in that industry is telling me they're pulling back on spending estimates. Now, again, there's tons of people out there, so it's not hitting the demand yet. But I just can't believe that it's not going to at some point. Anyway, that'll be a really interesting earnings call to listen to, because the one thing when you're looking at an NVIDIA is that their margins are not going to be sustained here, right? They're not going to be a 60% margin company going forward. They're probably going to be high, but not that. And margins, to me, flat out demand and margins are the story, because that's what you get a little bit nervous about, because we actually own NVIDIA, not in big size, but we picked some up right around $100. And as an investor in it, what concerns me, if I just look at the valuation based on what they've done recently and what they're doing, it really is fairly sober, especially in this market, given the comps. The problem is, in a setup like this, those margins can get squeezed hard and fast depending on market conditions. And that price to earnings multiple, and again, I bring it up because it's guys, there's better ways to value companies. I am not a PE ratio guy. I just use it because it's probably the valuation metric that most people are familiar with. But what concerns you, when, as weird as this sounds, right? Owning a business that has really high margins is a wonderful thing. I'm not saying it's not. But the one thing you have to keep an eye on is those margins. Because those margins, if they slip, those valuations can get turned on their ear in a hurry. And so you just, it's going to be something we're really watching. Like on the flip side, I'd look at a Google, right? And although you've got, government threat, and that's obviously been a bit of a weight on their stock for some time, and I think it's overdone. But then you look at a company like Google with their history, right? Their margins didn't just double in the last 2 years, right? And so you look at their valuation here, and in all likelihood, that's going to be a cheap price to buy this stock. The problem with companies like NVIDIA, even though they're killing it right now, and based on what they're doing, they deserve this valuation. I think that they're worth it. But like I said, the question is, can they maintain those margins? And I'll just tell you, the answer is no. They're not going to maintain 60% margins. The question then becomes, okay, how quick are those margins going to drop? What is making them drop? Are they losing market share too? And to be fair to NVIDIA, I don't see that. They are still by far the dominant player in that space. But they're, it's kind of like Tesla, right? There will be more, there will be more competition coming online there. So very interesting, something to keep an eye on. But like I said, we're all still caught up in the trade wars, the trade issues, and that's going to continue to be the name of the game. I'm really interested in where we go from here, because there's a part of me that thinks that this market is going to be range bound for a while. So maybe the highs that we had earlier this year and the lows we had earlier this year will hold. That would make a lot of sense. But at the same time, Chase and I were talking about this morning on our investment call. I'm leaving myself open to the idea. There's a different feel today. This is beginning to feel like a market that, for whatever reason, wants to run. So in that light, now I don't think it's any of these things. I don't think you're at a place where you can come out and call it yet. You got big major stocks that have not broken to levels that would suggest you're on the verge of really breaking out. But like I said, when I see the action and stuff like CoreWeave, what's it up? 184% in the last month since it IPO'd or something like that on no news. I think that there is some right tail risk here for whatever reason. And look, on a fundamental basis, it's not attractive at all, not because I think everything is horrible, but because I think one of the biggest issues you're going to have in this market is I think that you've got a really high bar. And I think it's going to continue to be kind of a stock picker's market in the sense that I think some companies will be able to reach that bar. I think a lot of companies won't. And we're at a fascinating place economically right now. We got the new consumer sentiment numbers out. And they weren't like blow your doors off good, but they were a significant improvement since the last reading and a pretty significant bump up. And that would correspond with what we've been tracking, meaning for us, I think that consumer sentiment you're going to hear a lot of people tie it to a lot of different things. For us, it's just the stock market. Okay. So if you want to know what consumer sentiment is, look at the stock market. Stock market rebounded. I'd expect to see consumer sentiment up. I think it's that simple at this point. And I think that people have gotten more myopically trained on the stock market than any other time. And we've talked about this a lot on the show, right? I think that the perception of the stock market has a feedback loop into the economy, and it always has to a degree, but I just think it's a much bigger deal now. And some of it's for logical reasons, right? When you look at the amount of people that have retired and where their assets are parked, it makes sense, right? The consumer sentiment would improve with rising stock market. And then you look at retail involvement and all that kind of stuff. If they're moneyed up and their stocks are going up, they feel good. It's beginning to feel like an increasingly ridiculous market, though. Again, not in all parts. That's the weird thing. But what's really running? I just feel like if you accelerate from here, things are going to get out of hand and get weird. That's my feeling. And I'm not at all saying, like I said, I think you got serious right tail risk right now. But just a lot of just so many different conflicting currents and tides and all kinds of stuff. Let's see. What else do we have here? Oh, gold. Gold got hit a bit on the day. Personally, I think that I think that short-term trading and probably even high-frequency trading and stuff is really masking what's going on in gold. So I think that gold moves are getting magnified by high-frequency trading, by short-term traders, all this kind of stuff. I think that gold has looked abnormally. I mean, look, it's a commodity, so it moves, but it's not normal for gold to be. I mean, it's not unheard of. But when you see gold just start routinely moving in 1.5% to 3% daily moves, that's excessive. And I really don't think the price of it or even the perception of price of that. I think you see this writ large across this market, guys. I think there's all kinds of scenarios where price action is going to be a liar to you because I think the tail's wagging the dog, right? Meaning, I think the volatility in gold is not reflective of the real price action. I think that the real buying is much more stable, much more steady, and much more consistent than that. I think that it's the marginal buyers and sellers exacerbating things with double X and triple X, levered up ETFs and all. And the same thing you're seeing happen in pretty much all the corners of the market. That certainly is not going to be, gold's not going to be any exception to that. But what I would say is that I don't think any of this price action portends bad for gold. I mean, it can still go any direction it wants. But the reason why people are buying gold is to diversify their dollar assets. And I don't see any need for that stopping anytime soon. Again, I'll be surprised if we don't go down and touch the retest the $3,000 level at some point in gold, just because you very rarely bounce through big numbers like that without retesting them, which we haven't really done yet. But that being said, none of these things are rules, right? They don't have to happen. But it's getting increasingly hard to follow the narrative here in this market because the price action and things don't look bad economically out there, but there's a lot of things that aren't doing well and the price action would suggest they are, and they're just not. And so like I said, I think on the right tail side of it, it's just this general feeling of the market and watching some of these, froth indicators, which is kind of what I call a core weave, a Palantir, things like that, Tesla, crypto. If you're in the past several years where we were going to rally, there typically had to be something of material, improvement, right? Something to justify. And one of the tough times I'm having wrapping my head around this recent move is that if you're going to accelerate from here, you're tempting at pushing now cycle highs on the valuation side. And I just find it highly unlikely that you're going to have economic performance that backs that up. But, then if you get rates continuing to come down, that is another thing. But here's the problem. If you get rates, let's extrapolate this out a little bit. Okay. Let's say today is indicative of like the next 2 months. And let's say you keep getting yields just rolling lower and lower and lower. I don't think that's a good sign. As a matter of fact, I think in the situation, the only thing that I think is going to be a sustained downward pressure on rates is recession. So, and this kind of goes to this weird place that the market's in that Chase and I were talking about last week, which is, there's really not a silver bullet for the situation we're in. And again, when I say silver bullet, it makes it sound like, like we need a silver bullet because we're in crisis. We clearly aren't. But you have a set situation, this is a perfect example. You've got a situation where part of the reason the market's where it's at is because the market is expecting multiple rate cuts. You got Fed officials saying you're not going to get them. When you look at the underlying data, as it relates to inflation and the cost of goods, I can definitely see why they're not. Right? We've also talked about how they're afraid of losing the back end of the curve. And if they're seen as being fiscally irresponsible, one would reason that would probably put more, pressure on the back end of the curve. And yet, when you look at some of the weakness in the economy, it would seem like a natural time to cut rates. But right, they're pressured in between a little bit like a rock in a hard place. I guarantee you they're seeing some of the data that they think could easily justify some additional cuts, but they're also seeing some conflicting data that says, hey, we still need to be aware of the possibility of re-ramping inflation. And so there's some constraints there. There's some issues. And this price action would suggest there isn't. The thing I'm going to be the most fascinated by going on through the rest of the year is whether U.S. markets continue to underperform international. They should. They absolutely should. But that to me is going to be the biggest story. And the reality is, it's probably more important to look what happens over the next 2 years. And guys, I cannot reiterate that enough. It's one of those things that I think that we all know and say out loud, but we probably don't think about and keep at the front of our minds consistently enough, which is that I think one of the easiest ways to have very good results in this market is to think long-term, especially now. And I think that's generally pretty solid information when it comes to investing. But especially in this environment where everything is seen as so short-term and so many, everybody's just looking, what are markets going to do? What's Trump going to say? And I was having this discussion with my brother-in-law last night. And we were talking about his 401k. And he's like, well, what do you think I should do in there? And I said, look, over the next year, who knows? These kind of things are really noisy. But what I said is, what is unquestionable. Now, look, if you're 2 years away from retirement, this may not be my advice. I'm not saying it wouldn't be, but take it with a grain of salt. Brother's in his mid-40s, probably has another 20 years to work. So, not an old guy, so he's got time. But I just told him, I go, look, if history is prologue, then what you probably want to do is take 30 to 50% of the assets in your 401k and spread them out across international markets. And he's like, really? And I go, yeah. And I just said, look, I'm not saying it's going to work the best over the next year. But I mean, guys, the bottom line is, it is what it is. I mean, it's the biggest valuation spread we've ever seen in those markets. And if, like I said, history is any indicator of what's going to happen in the future, then the right play by definition is to substantially increase your allocation to international equities. And then you look at them on a valuation basis, like we've talked about, and it's not impossible, but it would probably be one of the biggest shocks of my professional life if international didn't outperform over the next 10 years. And that doesn't mean they're going to kill U.S. markets. I just think you're at an extreme point where I think if U.S. markets go up anymore, I kind of feel like international's got to go with them. Now, again, we don't know any of these things for fact, but I'm just saying it's just harder for it. I'm having a very hard time envisioning the valuation gap that currently exists to continue to exist, especially now that so many more people are aware of it. So that's going to be the thing to really, the most intriguing thing about the next 2 years to me is watching that play out and seeing if that happens, seeing if that migration of U.S. assets continues to occur. And, boy, I will be shocked if it doesn't. I will be absolutely shocked if it doesn't. But hey, it wouldn't be the first time this market shocked me. I'm not really sure on what data we've got. The data that I've been focused on all week is just being really interested in what NVIDIA has to say. And then on the trade side, any updates on the trade front? I don't really think so, guys. And quite honestly, I really think that a lot of this is noise. And I think that a lot of traders are just playing the noise, right? Just trading it, enjoying the volatility. You got to keep an open mind. You got to be open for things changing and evolving and all that kind of stuff. But I continue to think that for the most part, a lot of these trade negotiations with other countries are really immaterial, meaning they're going to get done. The issue is us in China, right? That to me, I'm not saying the other ones don't matter, but they matter less. Okay. And it's just as simple as this. You got the two biggest economies in the world, and what they do matters far more than anything else. And where they go, virtually everybody is going to go along with. So, I think all of this market, we're not going to do trade with Europe. I thought that was dumb at the time. And that's quite honestly why we didn't add any more shorts to the portfolio when that market got hit that day by that news, because I'm just like, look, once again, to me, it's just all about China, right? Like, now, if you don't do a deal with China, if that goes sideways, then all bets are off, because certain people are going to go with China, certain are going to come with us. That's when things get really dicey and really ugly. But I think that so much of this is just nonsense and tail wagging the dog until you figure out what's going on with China. And so far, we don't really know. We know that it appears as though Trump has pulled back quite a bit on the threats. I mean, we know that he's pulled back on the tariffs, but it seems as though he is much, better poised or better positioned or ready or accepting of a deal. But until we see the data or until we see the details, I'm not really sure. The one other thing that I will say too, look, there is risk, and I'm not saying this at all. There is risk to owning Chinese equities, but I think the risk is overbaked. And I've heard a lot of comps to Sberbank, which was the really cheap bank, that probably the biggest and most established bank in Russia. And a lot of people, I remember almost buying stock because it was so bloody cheap as a value investor. And when we ran into those issues with Russia, we shut them off, right? So if you owned Russian stocks, you got up the next morning, you just didn't see them in your account. I think you still had a claim to them at some point, especially if things became thought out and uncontentious. But they were just gone. You couldn't sell them. You couldn't do anything. You couldn't access them. You couldn't trade them. Okay, and so I've heard people say that could happen in the U.S. as well. Could it happen? Absolutely. Okay, but it's not at all the same. Okay, if we pull that trigger, if either China pulls that on us or we pull that on them, that is a completely different animal than us doing to Russia. Think about the amount of investments Americans have in China compared to what we had in Russia. It is so much more deleterious and harmful to both our economies if we started doing that than, as opposed to Russia. I mean, not only was beneficial when we did it to Russia, but there was no real pain. This would cause serious issues. And more importantly, there's a point I was making this morning on our investment call to our team. I was like, and guys, I am not telling you to go out and buy Chinese stocks, okay? I don't know whether that's appropriate for you or not. If you do, I would keep tight sell stops, be aware of all the issues there may be with ADRs and all that kind of stuff. But my whole thing is I don't think you're just going to wake up one day and see your Chinese stocks 86th. I think you're going to see a breakdown in trade talks, and maybe this and maybe that, and then eventually that resulting in things being delisted. Could I be wrong? Yes, but I do think that threat is overblown. And I still very much believe that especially a lot of these Chinese tech companies look really attractive here at these prices, especially with the fiscal stimulus that Beijing is rolling out right now. So as far as the rest of the week, like I said, the biggest thing I'm focused on is NVIDIA earnings tomorrow. Not just the move it has on the stock, but I think there's going to be really interesting insights to how they're dealing with the potential of new competition coming online, and all the different things that they're dealing with, what their margins are, where they see demand. And I think that's probably going to give us a good look, certainly a more complete look into the, obviously the semiconductor world, but also the AI world. So that's certainly something that we're going to want to watch there. So anyway, as always, guys, we have expanded our footprint. So you can find us on YouTube. You can just Google Know Your Risk Podcast. No more Know Your Risk Radio. It's the Know Your Risk Podcast, and you go to knowyourriskpodcast.com. So we've fully gotten integrated here, and we're in the game. And again, you can find us on YouTube, Facebook, not LinkedIn, not InstaFace, Instagram, TikTok. You find us on all there. And like I said, if you want to see video, you can get that on YouTube as well, and on our social media sites, other social media sites like Twitter and TikTok, etc. So anyway, until tomorrow, have a wonderful evening. We'll see you guys tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.